The next learning objective is to classify assets and liabilities as either current or long-term. So before we talk about classifying assets and liabilities as current or long-term, we need to know what the term liquidity means. So liquidity is just a measure of how quickly an item can be converted into cash. Something like cash is already cash, so it has the highest liquidity. Next on the list of liquidity would probably be accounts receivable, because accounts receivable usually do within 30 days. So they will probably be converted into cash within 30 days. And then at the other end of the spectrum of liquidity would be like our land or our factory. It's going to be a long time since we plan on selling our land or our factory and converting it into cash. So now when we create our balance sheets, we're going to classify the assets and the liabilities as either current, something that's going to be turned into cash within the next 12 months, or long-term. And within each section, they're going to be, well, at least within the current section, they will be listed in order of their liquidity, from most liquid to least liquid. So let's talk about current assets. So an asset is considered a current asset if it will be converted to cash, sold, or used up during the next year. Examples include cash, AR, office supplies, or any other type of supplies, prepaid expenses like prepaid insurance, prepaid rent. Those will be used up or converted into cash within the next 12 months. So any assets that we expect to be converted to cash, sold, or used up during the next 12 months will be classified as a current asset. All other assets would be considered long-term assets. So these are not going to be converted into cash within the current year. Now, within long-term assets, we have some categories. The first we'll talk about are plant assets. These are also called fixed assets or property, plant, and equipment, or PP&E for short. These include land, buildings, furniture, and equipment. These are all not expected to be turned into cash in the next 12 months, so that's why they're considered long-term assets. Now, some companies also list long-term assets under another category called long-term investments or other assets, which is just a catch-all category. But the most popular category is plant assets, also known as property, plant, and equipment, or fixed assets. Now let's talk about how to classify our liabilities. So a current liability would be any liability that must be paid either with cash or goods and services within 1 year. Now you might be wondering, well, what do you mean pay it with goods or services within a year? Well, remember, unearned revenue is when we receive cash from our customer for something we've not performed yet or some product we've not sent them yet. So technically, unearned revenue is a liability. So if we expect to give that product or service within the next year, then that liability would be considered a current liability. But when we're talking about current liabilities, most of them are liabilities that we will pay with cash within the next 12 months. So some examples are going to include the ever popular accounts payable and notes payable due within the next 12 months. Also, salaries payable are obviously a current liability because your employees expect to be paid within the next 12 months. And interest payable. And of course, the unearned revenue, like unearned subscription revenue. So those are all liabilities that we expect to pay with cash, or in the case of unearned revenue, give the good or service within the next 12 months. So those are all considered current liabilities when we create the balance sheet. So that means all other liabilities would be long-term liabilities. They are not due within the current year or the operating cycle. So some examples include notes payable with due dates past 1 year, mortgages. Now, technically, if you're paying part of your mortgage every month, then the part of the mortgage that's due within the next 12 months would be considered a current liability. Anything past that would be considered a long-term liability. But that's getting kind of picky right now. All right, let's go look at Josie Smith's Accounting Services balance sheet. Now, this balance sheet looks a little different because it's called a classified balance sheet. All that means is we're going to classify assets as either a current asset or a plant asset. Now, plant assets could be called fixed assets or property, plant, and equipment. So notice under current assets, we've got all our assets that we expect to be converted into cash within the next 12 months, or in the case of supplies, to be used up within the next 12 months. AR, we expect to receive from our customers within the next 30 days, so that's obviously a current asset. And then the plant assets are our assets that we don't plan to convert to cash or use up within the next 12 months, such as our furniture. And anytime we have our furniture account, which is something that's depreciated, we have to have its companion account accumulated depreciation. And then under liabilities, we're going to list all of our liabilities that we expect to pay within the next 12 months, or in the case of unearned revenue, we expect to give the service or the product within the next 12 months. These are all considered current liabilities. And then anything beyond 12 months would be considered a long-term liability. Apparently, this company does not have any long-term liabilities. If they did, they would be listed right here after the current liabilities. And so that's what a classified balance sheet is. So you're going to split up the assets between current assets and plant assets. Some students like to think of those as long-term assets. And liabilities will be broken down into current liabilities and, if there are any, long-term liabilities.